Hey traders, Crash Halted
Sure.
here on the 24th of July, Wednesday evening, 1700 Pacific Standard Time. We're just going to do a little last minute academic session. It's going to be kind of random with a few key points that I wanted to point out. I got a few traders in here. We'll start off asking some questions that you guys might want to ask, and then we'll go into a couple things that I wanted to talk about, which really has to do with the speed of trading the NQ and figuring out how to get into trades with better entries, better risk management, and thus a better win rate and revenue, take home revenue. So that's what we're going to start off with right now. Everybody can see my screen. I have the NQ iSnipe chart up, which is a Flex Franco 10-4-3 chart. So why don't I just start off by opening it up? I've had a few conversations individually with several of you about some of the stuff that we're going to talk about today. So this might be a little bit of a review for a couple of you, but I think it'll be good just to have a group discussion to just kind of everybody talk a little bit about some of the stuff they're struggling with or stuff that they found helpful. Because what I really want is for the people that are struggling in the impact trading room to be able to become longer term traders, meaning they can last in this field without blowing out, either their own money or the prop firm accounts that they are getting into. So let's just open it up real quick to any comments or questions. What do you guys want to see? Is there stuff, let's just go down the list. Bill, why don't you take us off at the top and either give me comments or questions or something you want to see or discuss.
Okay. Well, the first thing would be maybe a little deeper dive into the new features you have on your chart. One of them being the doji, and then those little dots at the top and the bottom of the candles. Is that something you could?
Yep, that was something I was going to go over today. Mm-hmm.
Okay. All right.
What else? Anything else?
Yeah. One other thing is, being as you know, very new to this, I hear you say, get a runner going and keep it going, and then you will say take one or two off. So I'm kind of assuming your runner is like maybe three trades that are at this, the same price, and then you're taking one. But I'd like an explanation of that, maybe, or if you wouldn't mind.
Okay. So I'll talk about legging in, legging out, ATM strategies with runners.
Yes, if you would.
Okay. Anything else?
No, that's it.
All right, Eddie.
Pretty much just my biggest problem is sometimes I try to catch the falling knife. So I've been trying to avoid that lately and it's worked out, but that has been like my arch nemesis for like the longest time.
For years. Okay. So we'll talk about learning to earn on the turn. Okay. And not catching a falling knife or a shooting star.
Yep.
Okay. Anything else? Nothing from you. Okay. Anybody else? McGuire, how you doing, my brother?
Good, good. At work right now. Just wanted to hop in and see what's going on.
Awesome. Did you have anything that you wanted us to cover specifically today?
I mean, to me, I haven't been on for a while, but I mean, my biggest thing was always, follow the trend, and when, like the gentleman just said before, like not, when to not be on the opposite side of the trend, and obviously learning when to take your stop loss, but more so it's figuring out when the trend is about to reverse or going with the trend. That would be mine. Always has been, to be honest with you.
Okay. All right. Monkey.
Um, just getting used to this and everything. Uh, no, I don't really have anything in specifically.
Okay.
For me, it's mostly getting just used to the pace of it, having traded the ES for so long.
Okay.
All this, just it tends to jump like 3, 4, or 5 points at a time or something.
Yep.
So that's it. That's all I have. Otherwise, I'll just listen. I know I'll learn. I know I'll get some nuggets out of this. So
Okay. And Matt?
So I think the one thing that I would want, mainly for everybody's benefit, because I know you and I have had this conversation before, it goes back to the ATM strategy and, when to properly exit a trade when either A, you feel like it's going against you, or B, when you see it start to really go against you, when to know when to hit the flat null button and when to maybe let it breathe a little bit in its excursion from the line. I know when you and I had had that conversation, that was a game changer for me because what I was doing was mainly taking trades when they would hit a line, and then mentally for me, I would get to a point where I would say, okay, I've got a 12-point stop loss, and I've got all these targets, and I'm just going to let it play out, quote unquote. And what I was finding is that, I might get a couple points, and then all of a sudden it would reverse, but I would never flatten. I would just kind of, there was I guess for me, a built-in belief model in, the stop loss that we have in there, and that you just kind of let it do its thing. And as soon as I started shifting that to when I'm seeing weakness around the line for a bounce, I would just flatten and I would pick it up again on the next trade, knowing that we've got hours of opportunity. And as soon as I started shifting that, it made a huge difference in my P&L, made a huge difference in my consistency, and just made trading a lot more fun because I wasn't so much worried about hitting the stop loss because of just those slight adjustments. So I think for everybody, just to make sure that they understand that, yes, we have the stop loss built in. Yes, it is a safety net. Yes, there are statistics behind it. But if you start to see weakness, or you get that, kind of fuzzy feeling in your stomach that maybe this isn't going to move, flatten, reevaluate, and enter again if you need to.
Yep.
So that's the only thing I had.
Yeah. Well, I'm glad because that kind of summarized what we went over last week together. And that is part of why I wanted to meet with everybody else, because I want to make sure everybody else kind of had that same mental thought process that I explained to you last week. All right, so I think we got a direction to go. So let's just start off by refreshing our memories because of what we do in this room. Because I think sometimes people forget that we have a lot of tools to our disposal, right? A lot of tools in the tool bag, a lot of arrows in the quiver. We're not a one-trick pony. We have a sniping system that's based off the iSnipe lines, okay, which is an if this then that. We have a set of parameters that people need to follow. If you follow that, then this is just historically about a 78% win rate, and it can be higher if you do some of the stuff that we'll talk about today. These trades are designed to give us between 10, 40 points, and then have the ability to use the lines to have runners, which Bill was wanting to know more about. And then this is our I structure chart on the right, okay. And I know you guys know this, but what I want to reinforce to everybody is that we use both charts together, okay. And I think people start getting lulled into sleep because we have so many options that they discard some of the options, either because they don't understand it, maybe it's too much to process, it's harder to see on the screen because they don't have it on their screen. So I do see that it's sometimes difficult to understand that we truly have a 4-component system. iSnipe, if this, then that, 78% win rate, 10 to 40 points, usually 20 to 40 points if you do it right. This is designed to give us 30, 50, 75, 100 point trade setups. Now, why am I going over this again? Because just like Matt just said, remember on iSnipe, okay, we have between 20 and 30 good setups every single day on average. I mean, it is a plethora of trade opportunities. People wait all day to get 5 to 10 points, maybe once or twice per day for decent setups that they like, while we are literally scoring hundreds of points a day. Now, part of that is because we trade the NASDAQ, okay? And that's the pro of trading the NASDAQ, is that the rhythms on this chart work much better than on GC, CL, or the ES or the YM. Every trading instrument kind of has its own patterns that it follows, and what we have found is that with the iSnipe, we have better rhythms between the lines. And with the iStructure, we also have 16 different setups inside of this chart. But if you were to look at the Fox 3 setup, for example, today, all right, let's just take a quick look at this. Today alone, we dropped how many points, Matt, roughly?
It was just a little over 600.
Yeah, I think at one point we were like 660 points down. I don't remember the exact number off the top of my head. I did come in a little bit late. But if you were to take the Fox 3 trades, okay, the way we teach it within the Navdar system, which is our predictive time cycle methodology for finding price within certain time windows, we know that we see patterns that occur on those timing cycles. And when some of those patterns are exceeded, and this is one of the biggest things I wanted to talk about today, is you must use this chart, iStructure, with iSnipe to help you to decide whether you should be taking some of these lines or not. Now, there's a couple things that are going to help us decide, right? Most everybody focuses on the iSnipe. It's the easiest to learn. It's the easiest pattern recognition from just price reacting or ping-ponging off of our ITS or our ATR lines. But we have to know when it might be an issue to not necessarily take that. So number one, I want to remind everybody, when I call a trade bias direction off the Navdar timing cycle, if I call a low to a high or a high to low, then we want 90% of our trades to occur in the direction that I am calling. Okay, we have about 5 to 6 different cycles intraday on a daily basis where we rotate the bias from low to high or high to low type price action. So obviously, this is a paid for service for people to understand the specific details, to understand the actual time windows that they occur in. And so I don't announce those all the time, but I'm pretty generous about telling people, okay, now I'm looking for an upward bias, the next turn high and the next turn low. And don't forget that if I draw a rectangle, okay, or a shaded ellipse at a top or a bottom of some structure, then that is where I am expecting price to go. Okay, I give you windows where we have targets. It could be Fibonacci levels, it could be moving averages, it could be ATRs, it could be numbers that are calculated off of volatility, it could be numbers that are calculated off of our Navdar cycle, which contains 12 years of data that gives us predicted price points. We actually, remember, we know from what happens today, tomorrow then we put up our price lines on the chart. So we want to see confluence, confluence, confluence. And I cannot say that word enough. Confluence between Navdar time cycle, between the structural setups with our price targets here inside of our time windows, to our ATR sniping lines. On top of that, what is our fourth thing that we look at? iSnipe 1, iStructure 2, Navdar number 3, but then we have Bookmap, which has liquidity zones and other order flow techniques like Market Pulse VPI that we teach in here to add confluence to highs and lows. Now, I personally believe most people are in here are struggling with the change that we had. We've gone through 2 changes in this room since the market opened. When we first opened up in the first couple of the winter months after the new year, we had kind of a standard pattern behavior and price action. Then we got into the summer months, and what happened was the volatility became markedly reduced. The VIX level dropped significantly down to the 12 and the 13 range. And now what we're seeing as we're coming out of the early part of the summer into the political season for the presidency in the United States, into the season of the Fed potentially changing interest rate decisions with his FOMC and the Federal Reserve Board, right? There has been a market change. And then remember, we showed a chart back about a week ago where we showed everybody that there was a issue, right, with the NASDAQ getting too far out of line with what was happening with the Dow. And so we showed the NQ versus the Dow Jones transports. And just for the sake of explaining this again or showing it again, let's just take a picture view of this. We showed this chart back up here the day after this doji occurred. And on this candle, all right, is when I showed that we had this max extreme between the NASDAQ, which is the green, and the Dow Jones Transport, which is the other high-low candles here, okay? And we had a massive expansion of divergence between them. And now what we've done, we said either the NASDAQ had to drop or the Dow had to climb or a combination of both. And now look what's happened. And part of what has happened, what has occurred in here that has caused such a drastic change? First of all, let's ask the question, why has the NASDAQ been dropping and why has the Dow been climbing? Somebody just give me a very simple answer to that question.
Are you looking for someone to
Yeah.
chime in?
Yeah, chime in.
Oh, okay, I'm gonna call it a rotation to safety.
Agreed. I would say the same thing.
Excellent. That's exactly right. We have had a change in value analysis. People have gone from risk on with tech to risk off with tech. They have gone from, what's the term? You know, where you're looking for stuff to explode, but it's not always value based. It's I'm having a mind blank. What's that?
Oh, I'm just gonna guess at it.
Yeah, no, you know, it's what you said. It is a flow to value. Okay, it's a flow to value, and that's exactly what we've had. We've had a shift, a mental change in the thought process on what the Fed's going to do, what's going to happen with the presidential cycle, with extremes up here. What stocks were causing the market to go up so much? Like 7 stocks, right? The FANG stocks. And inside of that, what was it predominantly for the last 2 months? NVIDIA, right? NVIDIA. And it just got too overextended. What happened when the NASDAQ was at these levels? Where was the VIX? The VIX was down at its lows, just like the Dow. And now there's been a VIX explosion, okay? Now, you guys know how I like to draw Fibonacci's. And so what we need to do always is just like we draw Fibonacci's on the ES and the NQ, we need to draw Fibonacci's on the VIX. And what happens is that the VIX can be stagnant at a point, 12.5, 13, 14, 15, and the stock market might act kind of normal. But then when the VIX gets close to a 50% or a 61.8 line, or a minus 23.6 profit target, it starts getting really whippy again. All right. Now, the other day, Tony, I asked in the morning, what was our points per minute move on the NASDAQ in the morning in the first 30 minutes. Do you remember what that level was?
Yeah, it was around 23.
It got higher than that. Anybody remember? 23 is what it started off with when this move started occurring. And then just a couple days ago, we were at,
Like 32?
yeah, like 32, 33. Okay? 32, 33. So when we are trading the NASDAQ, according to the rhythms that we are going to be looking at, we must monitor a couple things. Excuse me just a second.
Kelly, can I throw something in there on that rotation to safety thing?
Just a second. I want to just finish this thought. So
Okay.
you must pay attention on your chart to two things. Okay? The VIX value price. That price in relation to some Fibonacci levels or key levels, just like we do with any other future contract. We pay attention to key levels. All right? And you must pay attention to a 1 minute ATR. And you must remember on top of that, where I'm going to ask you guys to be totally honest. Monkey, just hold on to your thought process. We'll get to that in a second.
Yeah, no
What
worries.
if you were going to do a self-evaluation and ask yourself where you lost money most of the time? Somebody give me the number one spot that they lose money in, time frame during the day. Matter of fact, everybody answer. Bill, where do you lose money the most? What time frame?
After market open.
Who said that? That was Shabuga Wolf.
Yeah, after market open.
Okay.
That shop zone.
Okay, what time? Give me an actual time frame, Stefan.
10 minutes after market open for about 40 minutes or so. That's my losings.
Okay, so from
Spot usually. I
open
get chopped up in there.
to the
So
first.
I stop. Yeah.
Okay, from
Yeah,
open.
about 10 minutes after market open because I'm not going to obviously take a trade the first 8 or 10 minutes.
That's right. We have a no trade zone for the.
In the butt.
Yep, we have a no trade zone for the first 8 minutes. So you're saying that from that 8 minutes to the first 30 minutes actually is very volatile. All right, who else?
Yeah.
Bill.
I would say also the slog time. It's choppy and the price trend tends to be horizontal and it just doesn't move very predictably as far as I can see.
That's right. So slog, for everybody listening to the video that does not understand it or our system, okay, is basically the lunchtime chop zone when the Wall Street traders leave their desks and they go have their meetings and their lunch, and the robots are mainly in control, and you start seeing the algorithms just kind of take over, and it turns into more chop. All right, that time frame. All right, so we said the open, the first 30 minutes. We said the slog. The slog starts roughly after right around 9 o'clock, okay, to 11 o'clock Pacific Standard Time. So that would be 12, right, to 1400 Eastern Standard Time for New York trading time frame. Okay, Eddie, when do you lose money the most if you were to do self-analysis?
The first hour.
First hour?
And then,
Okay.
Yeah, and then like towards later in the afternoon, like towards almost like maybe the last hour.
Last
like
hour.
and a half.
Okay, good. So that's first hour, last hour. All right, McGuire, how about you? If you can't answer because you're at work, that's fine.
Yeah, I'm sorry. What did you ask, Crush? I'm sorry.
If you were going to do a self-assessment, we're taking a poll here. When would you say you lose the most money? What time of day?
During the slog, like you said, that's actually most of the issues that I had before is when it's consolidating like that and not being impatient.
Okay, so that's good. Monkey, what about you?
Mine's not necessarily time, it's when the volatility gets cranked up too high.
Okay.
Which normally, like you say, in that first 10 minutes. which
Okay,
I try to.
so I would propose, that the first 45 minutes, okay, this is something that I want to talk about. The first 45 minutes the volatility is much higher. Okay? As the day goes on and we go into the slog, the volatility gets usually lower and slower because there's less volume, thus less volatility. But because it's a thinner market with less volume, they can chop it around easier because, when you have less volume and somebody comes in and puts a 100 lot on, that can spike price very quickly in that slog time frame because there's not as many orders going through. And so that's why the slog time is dangerous. And then the last hour, like what Eddie said, remember this, guys. I know you know this, but I'm beating this horse because I think this analysis that we're doing right now will help people to trade smarter and smaller, or maybe not trade at all during these time frames. So remember, the slog, thinner market, less Wall Street people actively taking trades, more computer bots, more algo trading. Lower volume means price can get pushed around more. Okay, so Hammer, you're talking about volatility. We just talked about that. The differences in volatility between the first hour, the slog time frame, and the last hour. They say that the amateurs open and the professionals close. Okay, the professionals close because they start coming back to eat, but they start playing games to trick people because they want to take people's profits at the end of the day. So that's why I'm always like, if you are green coming into the last hour, then you control your risk. How do we control our risk during these time frames? But I'm going to talk about that in just a second. Let's finish talking. Matt, what about you? I want to finish this poll.
Yeah, it's first hour for me when I get really amped up to get going with the day. Last hour for me is kind of okay. It just depends on what I'm taking. But to echo the slog too, it's very similar. Get chopped up quite easily, and I think the thing with the slog is the boredom. The boredom of the market, and the itch to get in and at least have some activity, but
Yep.
for sure the first hour.
Yep, the boredom of the market, feeling like there's not as much action. So to not be bored, you start taking trades, and maybe taking trades you shouldn't be taking. Okay? How about you, Tony? Last one.
Yeah. I'd have to say the first maybe 45 minutes or so, it's kind of like double dutch. You kind of get the rhythm of the jump rope.
Yep.
And, my best trades come when the day starts to fill you. It's rhythm. But when I'm anxious and ready to get rolling, it's like, dude, I got 6.5 hours straight. Why am I doing all this for 45 minutes?
Yep. Okay, so in summary, the first hour won. Okay? And then the slog was number 2, and then the last hour was number 3. Now, I think a lot of the stuff in the last hour, we honestly have less traders in here in the last hour because most everybody that's working or doing stuff ends up there's just not that many of us left by the last hour of the day, either because people like Ty, take their profits and run, or people got to go get into work, and so we just have less people. But the last hour is extremely dangerous, just like the first hour. I do think it's better to trade the first hour than the last hour, but let's talk about some things that actually will help us during that. So my biggest thing I wanted to talk about today, besides going over some of the stuff on iSnipe, like what Bill asked, was risk management and trade entry. So let's just finish talking about risk entry. And again, Hammer, I haven't forgot about you. I just want to finish my train of thought that I have. So for risk, what was the first thing I said we needed to track for risk management? It was the VIX. Okay? The VIX, you need to know levels, just like price levels, and you need to understand when we're getting close to a Fibonacci level, because it will start spiking. When it hits, just like the NASDAQ does, its characteristics are the same. When it hits a 50 or a 61.8 type range on a Fibo, it's going to move. The second thing is a 1 minute ATR. If you do not know how to calculate a 1 minute ATR, then you need to come talk to me. This is a mandatory must, that you must be able to process 1 minute ATRs and know what we're doing. Because trading the NASDAQ when it's at 15 points per minute versus trading the NASDAQ when it's 33 points per minute is a complete different ballgame. Now, let's get some rules out there, okay, about when we're going to talk. Now, Matt, do you remember what my rules are roughly for trading the VIX? What we're looking at in the VIX for levels?
Yeah, so if the VIX is currently sitting greater than 15.54, that's bearish, and anything less than that would be bullish. Generally in nature, doesn't always mean that, but in general sense it should be.
Okay, I'm looking. That's good. I'm looking for specific ranges when you want to maybe trade less or trade not at all.
Oh, so if the VIX is greater than, I want to say it's like 18 or 19, that is a period of time to be observant and not trade.
Okay.
I
Yep.
think it's that level. It might be above 20, but when
Yeah.
it gets to that extreme level.
Yeah, no, that's pretty good. So basically, if we are 10 to 15, okay, that's a pretty normal range to trade. And pretty much, I'll say up to 18, okay? So between 10 to 17, that's the cutoff I'm going to put. 10 to 17 is our normal rhythms using iSnipe. So that means that we are looking for first touch rolls of our ATRs and taking trades off of that when we see a reversal. We want to learn to earn on the turn. So what does learn to earn on the turn mean for us? Well, we've enhanced it a little bit this last week, testing a couple things that come from people's use of footprint. And I don't think it's very easy for most people to trade footprints because it's so much information inside each candle. And a footprint reader of the ES, somebody who can read the footprint of an ES cannot read the footprint of the NASDAQ the same way because it's not the same. But with Monkey's assistance, we have added a couple things in here to help identify these reversals to make it a little bit easier. Okay, so what we want to do, and I'll get into more specific terminology, we want to look for three things. We want to see a bounce off the line with a doji. That's what these blue candles are right here. Okay, we want to see a doji. The second thing we would want to see is two dots on the top or the bottom. They're white on the bottom, gold on the top. Okay, that is telling us that basically the auction has reversed or stopped at that point, and you're running out of buyers here, you're running out of sellers down here. Okay, a single
Hey,
print.
Kelly,
Yes.
can you expand the x-axis a little bit just so we can get a little bit of a...
Yep.
Yep.
Yep. So what we want to do, and I'll find one that is a little better. I don't want to get lost on the symbology yet because I'm still talking about the VIX numbers. Since we're here, I just want to talk about it.
Okay, one thing real quick. Is this VIX term something new? I don't remember hearing you talk about this. Remember?
All right, we're monitoring.
Yes.
So
mute yourself, Stefan.
Huh?
You got to mute yourself
No, I asked
after
you
you
a
talk.
question. I asked you a question, buddy.
I know, but then I'm hearing feedback from you. So after you ask, just mute so I can answer.
Oh, okay. Sorry. All right.
No, that's okay. It's just I get so much feedback, I can't actually answer. So in the last week or so, while you've kind of been away, we have added some symbology to the candles. Okay, and that's what I'm going to go into a little bit more detail in just a second. But what we want to do is we want to look for a reversal. Okay, and I'm going to explain this more. But number one, a doji. Number two, white dots on the bottom, yellow dots on the top. Just to keep it simple. Caveman math here. Number three, we want to see a fractal on the top and the bottom. The reason we put the dojis in is because it can identify the change in direction or the indecision here between buyers and sellers, from buyers shifting now to more sellers. Indecision, a wick equal on the top, equal distance on the bottom, on top of this little square. The doji is supposed to develop about a candle before the fractal, so that gives us a few points, hopefully, of being able to get in better. Adding the end of an auction, okay, with the white dots on the top, the white dots on the white dots on the bottom, and the gold dots on the top, just gives us another image that there is a reversal. And then we're looking at momentum, okay. If we have a change in direction that's associated with, let's find one here just so we can talk about it very specifically. Here we go. Okay, this triangle on the top here. Okay, here we have the blue doji candle. We have the golden dots on the top. We actually add a momentum indicator right here. All right, and don't worry about this X for now. That's too much. It doesn't happen enough. It's too hard to see when it's shrunk down. But that would be a great place to look for a reversal pattern. And you can see that when we got all three of those, right, a doji, a single print zero, which is what those two dots are for the auction, and a momentum indicator saying that now momentum actually is increasing to the downside. That triangle is telling us that if you looked inside a footprint, that momentum is starting to go to the downside with the sellers. Here, after we get a single print zero and the buyers start coming in, the buying momentum is pushing up, and we get a triangle to help with that imagery, help understand. So when we say learn to earn on the turn, having as much confluence with these new indicators, and again, I'll go into a little bit more detail on this in a second, is what we're looking for. Now, going back to the conversation that started this, the VIX, the levels for the VIX. 10 to 17, we're playing the normal bounces off our lines. If you are between 0 and 10, we usually see that level of ATR, points per minute, 0 to 10 points per minute. I guess it's not 0, but 1, anything above 0. Then you're usually in a European type market, after hours type market, or in the slog time frame, or maybe in the summer months, or on a shortened holiday day, where you're just not getting as much participants in the market, so your points per minute slow down. Recognize that when you see sub 10, for us, most of us during the day, that is an indication of what is going on in the slog time frame. And that is when price can be jacked around a little bit quicker by one or two larger order entries. So 0 to 10, slog time. 10 to 17, kind of that normal time frame. 18 to 22, we start picking up momentum, and people need to start taking notice and start looking to play shifting their risk management. The risk management means if you're trading minis, you go to either half-size minis, or depending on your account size, and so this differs with everybody because it truly depends on your account size. If you're trading a $25,000 or a $50,000 prop firm account and you only have $1,250 to $1,500 stop, intraday trailing stop, you cannot afford to trade minis. You must be micros. And if you're already trading micros, then you might need to shift it to half the number of micros that you are used to trading. If you are 22 to 25, you should really start going to micros for the majority of you. Some of you, if we get greater than 25, should not be trading. If you've gotten really good at this system, where you have a full system, you're not looking off of my charts plus your charts and trying to trade off of Rhythmic, or using 3 different platforms, one for order entry, one for visual aid, whatever. We've got a lot of combinations of different people having different chart setups in here. If you're one of those kind of persons and we're skipping above 25 points per minute, you probably really shouldn't be trading. And if you're clipping at 33 per minute, then I'm just telling you, most of you are going to get eaten alive. And so, coming back to the first hour, here's what I think you guys should do, because I think most people are losing for sure in the first 30 minutes. I used to not really call out trades in the first 30 minutes because I didn't want people trying to call or match my trades while I'm trading it. Because obviously I have a little bit of a different experience level with my own strategies in here. So I'm going to know my strategies better than anybody else. Not that I'm a better trader, I just know my strategies probably a little bit more. So I might be able to maneuver in and out of trades faster. As you learn, then you can start doing more. But I'm gonna ask you to answer honest question. If you are losing in the first 45 minutes of trading, then you need to do a couple things. No trade zone first 8 minutes for sure. Maybe no trade zone for over half of you for the first 30 minutes. And if you're still losing because you've tried to, skip the first 8 minutes, but you started the 20 minutes to the first 45 minutes, maybe you wait till after this time frame. Just see if this works. Wait till after 21 to 25 minutes past the hour. So that's 7:21 to 25 to 9:21:25 for those on the East Coast. Because what that allows us to do is like what Tony said. We've had this conversation before. Is that the patterns are very chaotic. You have all the open orders that come in the open range. Then we have a spill up or spill down that can last from the first 8 to the first 30 minutes, and we can have a couple different variations of what that spill pattern looks like. Then from the spill pattern to the first turn of the morning, AM or PM turn, whatever it is, everybody here knows I'm always looking for an AM turn or an AM low or an AM high. That AM low or that AM high does not start to truly reveal itself until after about 21 to 25 past the hour. And once we start to reveal whether we're having an AM low or an AM high, the pattern and the rhythm gets more predictable. So more of you will be able to make more money and have less risk if you trade less in the first 50 minutes. 50 to 55 minutes. Stop trading in that zone if you're losing. Yes.
I'll just say in the past 2-3 weeks, I have purposely not traded my own account until about 10:30 Eastern, which would be 7:30 Pacific. And it's made a world of difference. And if I did trade within the first, 30 minutes to an hour, because I used to always do it, I would be in sim. But I've been having better success waiting 30 to 60 minutes after the open when the rhythm starts to pick up, and it's made a world of difference. Not to mention less stress level of being behind, trying to catch up.
That's right. Why start off behind the power curve in the first 45 minutes when, and I'm going to come back to why I started the conversation off with what iSnipe gives us versus what iStructure gives us. The reason I did that is because, right, I want you to remember that having 20 to 30 setups just on iSnipe alone and then adding another 20 setups a day. So now we're like 40 plus different setups every single day that we have the option to trade. Why blow our whole lot in the morning in the first 50 minutes when we have an 8 hours of trading that we can have up to 40 different trade entries, and now we're digging ourselves out of our hole for the rest of the day. The same thought process needs to come into the point that at the end of the day, if you are green, if coming into the slog time, the lunch time frame, you are green, change your trading behavior pattern. Go from micros or minis to micros. Go from minis to half the number of minis. Go from micros to half the micros. Or hit your profit target and do not trade anymore. This game is about attrition. This game is about who can last the longest. If you cannot control the risk, you will not last multiple years in this environment. Let's just look at one example. Hammer, I still haven't forgot about you. I just want to continue with this pattern here.
No worries, brother.
Okay, look at this. This is the other day on the 23rd. What time frame are we in right here?
It looks like the first hour.
Yep. Okay, so here was market open. Okay, at 6:30 in this area of time. And then we're coming over here to the right side. And here's like 7:30-ish roughly. Now look, we've had low, high, little pullback, high, pullback, high. Now I'm going to actually expand this because it's kind of hard to see the true distances in this time frame. Oops. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 different cycles, high to low, high to low. What does that range look like? 50 points. 70 points. 68 points. 43 points. 70 points. Okay, 88 points. Now we start rolling over. What do we probably call this down here? AM low. Okay? We have to get out of this chop. If you are going to trade in the first 45, 50, 55 minutes, then you need to become an expert sniper. Now, I'm going to talk about sniping next because I want people to know how to be able to trade this. Because we want to capture some of this stuff. But if you happen to look down and it's clipping at 30, 32 points a minute, you're talking about eating up one of those whole legs in 1 to 2 minute time frame. That is a ton of volume and price points that are moving in 1 to 2 minutes. And if your system doesn't allow you to do it because you're having issues with Rhythmic or Trade Copier or maybe NinjaTrader versus Sierra Chart, or your computer doesn't have the memory or the processing capability, whatever it is, you need to understand the limb facts. That's what we call it in the Air Force. Limb facts. What are your limb facts? Your limiting factors. You must understand what your own personal weaknesses are. You must understand what that's internal limb facts. And you need to know what your external limb facts are that are going to impact you. If you have issues with Rhythmic, trading platform, order entry, trade copier, those are external. Now you add that to your own inability to trade because of experience. You need to understand how that affects your risk management. Now, I'm going to get into sniping here in a second. I want to come back to Monkey because I want to let him bring up the point that he wanted to bring up. You still there, Monkey?
Yes, I am. I had muted myself.
That's okay.
Just that when you're talking about rotation to safety, for any people that are very new here, and correct me if I'm wrong here on this, Kelly, but it was always explained to me that the Nasdaq is the more highly speculative index, the S&P, and then when you get to the Dow, that's your 30 biggest. Those are your staple companies.
That was the word I was
So-
looking for. That I was having a
What?
mind blank on. Speculative. Yes.
Oh yeah, okay, yeah. So yeah, I mean, what happens is there are funds out in the world that are required to be in the market at all times. And so what they'll do is, if they feel like there's going to be some higher volatility or they have some indecision, what they'll do is they'll rotate into the Dow, because those are the stocks that are not going to get, probably not going to get crushed as heavily on some kind of a downturn.
Yep. Those are called the value-based stocks in that.
Yeah, so I don't know. I was just going to throw that in there because.
Yes. So excellent points. Okay. We're talking about speculative rotation. Mike was talking about a rotation from speculative instruments, all right, to value instruments. So NQ to YM to Russell, stuff like that. There is always a rotation, and that's exactly what we saw, right, on this chart right here. I actually probably should create a chart that shows. I was actually thinking about doing this 2 days ago when I was thinking about this talk. I just didn't have the time to do it with my house and everything. I want to overlay the NASDAQ with the YM. And I told Matt and Tony the other night that once people actually get to where they become a little more skilled in what they're doing, I want to teach to trade other instruments. Trading the YM is a different beast than trading the NQ. We use a different kind of charts, different kind of setups. And so when people get more money, when they get more comfortable, more experience, we will continue to expand to trading other instruments. I want to get to where people can trade the things that I like to trade: ES, NQ, CL, oil, gold, GC, YM. And then we also want to expand into playing options. All right, we're going to have an options part of our room as well, where we play the intraday and interday cycle rotations, where you don't have to snipe quite as much. You just buy one or two calls or puts or vertical spreads or whatever it ends up being, and you let it sit for an hour or two, or maybe a day or two, and ride our Navdar cycle to make money while we're day trading the futures. But thanks, Mike. Appreciate that. Okay, let's get into sniping just for a little bit. So depending on what that 1 minute ATR is, okay, let's just talk about this a little bit more off of our iSnipe. Now, this is also a benefit, in my opinion, to trading something like Fast Track's prop firm account versus Apex. I wanted to talk just a little bit about this today. If you or anybody, not necessarily Apex, anybody that has a intraday trailing stop versus any prop firm like Fast Track that has an end of day trailing stop. Now, if you heard the CEO of Fast Track talk at all in the last couple times he's done his little YouTube webinars, he talks about when they designed the company that their goal was to take what, and he doesn't use the term Apex, but he says, the large firm that allows you to have 20 accounts. We wanted to take that aspect that they had because we thought that was a really good aspect, letting people be able to trade up to 20 accounts. But what we didn't like of those firms is the firms that have the intraday trailing, they're just there to make as much money off of people failing because most people can't control their risk enough to keep the accounts, right? We know that 20% of people can even trade these prop firms and get to a PA account, and we know it goes down to like 5% or so of people that can actually get payouts. So it is very hard to win on PA accounts. So I like the Fast Track because what it lets you do is in periods of time where you have above a 22 point per minute ATR, or where the VIX is, at one of it's rallying above 15, like what Matt said, or it's getting near one of its Fibonacci levels where it starts pinging off the wall, we may have to skip 1 or 2 lines. So in addition to not trading in the first 50 minutes, it may be that you wait for the larger setups. Now, let's just look at this for a second. I'm going to shrink this down and I want to pull something up. If we were to look at this downtrend here, and I don't know where we're at because I haven't looked at anything specifically. We didn't really blow through that. We didn't blow through it, but we didn't really bounce on them. Let me just find an example where maybe we sliced through something in the morning or somewhere. Because the point I want to make is what the image looks like when we're slicing through something versus when it's a little more manageable. Again, I should have had a couple slides prepared to make this point so we didn't have to waste time, because this is just straight down. You don't even have time for stuff to... Maybe we'll look at something going straight up, but there was hardly any pops. Let me go back in time here. Let's just go back and look at the morning of the 23rd. I don't remember what this looked like because I didn't trade this, but let's just look at this for a second. Not a good example. Yesterday was more of a muted trade. I'm just going to find something random, totally random in the morning somewhere. Let's look at the 18th here. Okay, here's one. Let's just take a look at this time frame here. All right, if we were playing our first touch rolls, right? We would say, oh, we're looking for the next turn of this ATR liner here. Well, we don't get a fractal. We don't have a doji. We don't have a single print 0 square pair. We don't have a momentum indicator. Here we have one, but look how fast this one is. Okay, this is a really good example. We've got the 4, 6, 10, 15 all lined up above us, and maybe even the looks like the 20 was above us.
What chart are you showing?
This is the iSnipe. Are you seeing this?
Okay.
iSnipe chart.
If you could expand it a little bit, that'd help.
Okay, so let me expand that a little bit.
Okay, there you go.
Okay, so as we see us coming down to the green 20 line here, right? We kind of have a very quick, I would call this a slice through. Because if you tried to buy this, right, where you're seeing a quick reversal off of the line, that meets our entry criteria right here. And look what it also does to us. Okay, let me blow this up even more. This is a great place to show how our indicators do not work. Is this a valid trade entry based off of our first touch rules? Yes. Are we getting a doji? Yes. Are we getting a single print 0 square pair down here? Yes. Are we getting a momentum change? Yes. Did this end up being a good trade for anybody who tried to do it? No. Okay? Because it very quickly whipped down, whipped up, and then came with a continuation of the trend down with an expanding wave with a lot of distance from the closest 4 and 6. A lot of distance. These are going down pretty vertically. So this is a pretty quick, sharp little move. So let's talk a little bit about maybe you wait when you have all these lines that are closer together above you and you're red over red. Remember, red candles over red background. Red over red, you're dead with an expanding cloud. A lot of distance between the 4. That is just a really strong power move away. That's like when you look at the iStructure chart over here, right? And you see that what have we done? we're just staying a long way away from the Fox 3. Large distances away from the Fox 3 before we ever get close to it. That's a very strong move away from all of our other lines. So how can we control that? That is a valid trade entry for us. All right, let's talk about what Matt and I talked about with us. Normally, we say we have a 12-point stop. And I had this conversation with Pavel over in the Czech Republic last week as well, because he was getting eaten up by a couple of these when the market was moving really fast. So number one, look at the daily ATR. Is this eclipsing at over 22 points a minute? Okay, over 25 points a minute? You got to ask that out. What is my VIX doing? How much distance do I have from the yellow line? That's a lot of distance from the yellow line. I'm having nothing but red over red over red over red, and it is pretty vertical. So understand what the chart is telling you. Now, we made one more change to our Flex Renkos. This is hard to see when you're looking at my chart through Discord, probably due to the size or the resolution and thus the speed and the closeness of the candles together when I have it more compact. Look at these candles. This has the Heikin Ashi, okay, candle portion added to it, which is a little bit different than, and I've just been testing this without really telling you guys much about this. But this is probably something we're going to add. If you look at the candles that I have here, okay, look at the bodies. See how the candles are actually different? Can you see that there's different sizes here? This is a Flex Renko 1043, like what we normally have. The candles here are actually a little different in size and shape. Okay? And look at some of the wicks. Now, let's come back over to the NQ, where it's the only chart that I've had all these changes come to. Look at the candles here. The candles are all more in line with the same shape. And as we get the pattern getting stronger, you see these initially have no wicks on them. Then it gets a little more migratory. We start getting some wicks on the top. Then we come down, no wicks on the top, only little tiny wicks on the bottom. Same thing here. Migratory as we come to the line, couple wicks, and then no wicks on the top. Start to see a wick develop here. Leads into a migratory or a change in the rhythm. Again, wicks on the top and the bottom. Couple more. And then we come into this power move here, which is more vertical, more quick, with no wicks on them. So start to pay just a little bit attention between the difference on the MNQ versus the NQ, where we have the Heikin Ashi candle added to this Flex Renko system here.
Kelly, can I throw something in real quick?
Yes, you sure can.
Okay. On the bars going down, the way these bars are set up and built, anytime you have a flat top bar, there's no price hesitation.
That's what
So
that's what
the
this is. Yep.
The open of that bar equals the high of that bar. And vice versa on the way up. A flat bottom bar is a strong bullish bar because there's no price hesitation at all. Bar opens at the low and it goes. So that's a visual clue you can take from that anyhow. And then like Kelly said, when you have on the red bars, when you have a wick above, then that's where you get some price hesitation. Those flat top bars are golden.
Yep. So for those that that have iSnipe and a Flex Renko system on your own chart, you can actually add this on your own. I have not focused on it or brought it up yet because we just added it last week, and I wanted to make some observations of my own before I said too much about it. Also because when it's shrunken down and people are looking on my monitor with reduced resolution, it's a lot harder to see, especially, it's a lot easier to see now because I have spread it out. But when I compress right, the candles, and I shrink the chart so we can see more, it's a little bit harder probably for you, depending on the resolution through Discord, on whether you can actually see the wicks down here or not. So I did not blow this out of proportion when explaining it yet, because I wasn't sure how much value it was going to have to people observing through Discord. However, I think on your own charts, talk to me one-on-one, and we can get this set up for you, and you can start to see this for yourself. Do I think it makes a massive difference? No, I don't. I personally think it's minor. Do I think it's beneficial? Yes. What I think is more beneficial is moving on to the point of discussion that I want to talk about now, which is risk management within our system. If we are clipping, above 22 points per minute, I'd probably even say for some of you, 20. Let's round it off to 20. If we are moving greater than 20 points per minute, then I think that you take your stop from minus 12, down here, and you raise it to like minus 5. So that if it pops up like this and comes back against you in this counter trend trade that we just tried to do, you don't lose 12 points, you lose 5. Now that's the first thing you can do to control risk when we're whipping faster. Is if it's moving faster, well, first of all, number one, you play more extremes. So we said when we're in that 10 to 17 range, you're doing the first touch rule. When you're getting 18 and above, I don't want you taking the 4s, the 6, the 10s. I want you to take the 15s or the 20s, and I want the trade to be more correlated on a 20 here with something over on iSnipe. So what would that look like? Somebody tell me, because I know some of you know. What's a trade where we have correlation?
Like with, it could be like a bounce off of a Bull 15 with an Eagle bounce, or a Mustang, Viper, Fox 2, etc.
Exactly.
Major line.
Exactly. That's my point about confluence. You guys have all seen this, and let me share this. All right. If you look at this, let me go slideshow from current slide. There's sometimes you just feel the patterns. And when you're looking at two charts together, as opposed to just the iSnipe. Now look at this price pattern here. What is the difference between this price pattern, right, and the one that we saw that all looked like this? Look at the vertical difference of the 4 and 6 line. These have a little more of a horizontal angle to the body. Its ratcheting is looking a little different. They're not as vertical. Where is price on the top of these Flex Renko bars in relation to that 4 line? Compared to, right, where is the top of these Flex Renkos in relation to these lines right here? You see the distance? You can see when that wave is expanding, when the lines are more vertical, when they are more stacked and all with that same vertical pattern. Red over red, distance between the cloud and the 4 line with the price, versus looking again at this. Start to recognize the difference of what a pattern looks like when it's going straight down. Straight down days, straight up days. And start to get the confluence between trades. So when it's whipping at over 18 points a minute, you need to start making sure that we have more major confluence between the price patterns. Any questions on that? Okay, so risk management. Oh, one last thing. So let's just summarize, and then we'll go to the thing. Number one, you watch the VIX. I've given you the ranges on the VIX to look at. Number two, you look at a 1 minute ATR. Number three, you look at formation of the ATR lines. Angle, slope, price distance from them. You tighten your stop, and you play more extreme levels, maybe the 20s and the 35s, as opposed to everything in between. If you take this, there's nothing you can do about this. This is a valid trade entry. The thing that you can do about this is to decrease your stop from 12 to 5. Now, I want to talk about changing your ATM strategy. I posted, and I will post in here, but I posted in the Discord channel. Okay, let me put this up here. When I was talking to Pavel overseas, all right, where did I put it? Where did I put it? Yeah, okay, I'm in general chat. I think it was the general chat. I gave it to him because it's where he, yeah. Okay. I'm going to actually post in, maybe do trade results, or trade notes. Oh, no, you know what I'm going to do it? I'm going to put, does everybody have, let me ask this question. Somebody said this in a minute. Does everybody have access to this Sierra chart? Can you guys see this on your Discord, everybody?
Yeah, I got it.
Yeah, I looked at
I
it.
got it.
Okay, I'm gonna put it in Sierra. I'll put it in Sierra chart. Because it's my settings for Sierra chart. The other thing you can do besides changing the stop, okay, to 5 points is we can change the actual ATM. And I want you to change the ATM when we start, if you have the ability to do so. I know some of you cannot do this by the way you guys are trading, your trade platform and how you're set up. But if you can change to what I'm going to show in here, okay, I'll reference it in general, but I'll put the post actually in in Sierra chart. I'm going to post an automated ATM strategy that allows your stops to move automatically based off of points moving away from you. So as price starts to bounce, if these bounces are really quick because we're bouncing 20 points per minute, you may get a good bounce off of this and it may go up 20 points and you may want to capture that, and those auto trailing stops will automatically come up and it'll be faster than what your hand can move stops manually. So I'm going to show you that. The other thing to help people become more profitable, right, is I think most people in this room can be above the 3 micros per minute. So what I've talked to a couple people, Bill, Matt, Pavel, is I want you to change your ATM targets. And this is what I want you to put your targets to, okay? I want you to actually do more lots. I've taught that per every $1,000 of equity that you have to spend. So if you have a $5,000 trailing stop loss, you can use 3 micros per $1,000. So if you have $5,000 stop max loss, then it's 3 times 5 is 15 micros. If you only have 1,500, then you're looking at like 5 micros. Okay. But what I think, if you start to tighten up your stop, then I think that you can change your ATM. Okay. And I want you to change your ATM to actually taking more micros. So this might help people not have to take more risk on minis, because now they can make more money on micros, because we're getting beyond the learning stage for almost everybody in here. But change your number of lots to 5 or 6 lots for every time you enter into a trade. Okay, instead of looking through it in here, I'm just going to tell you. Where did I put it? Okay, here it is. So you can look at here. Okay, before we've been 8, 10 point, 12, 8, 10, and 12 point targets, all right? So maybe you do 5 or 6 lots now on the MNQ, and you do 3 points, 5 points, 8 points, 10 points, 12 points. Or you go to something even smaller, okay? And this is why I would do something smaller after I tell you what it would do. Let's say you go 2 points. It's kind of dependent on you. If I'm trading minis, I'm more willing to take like 2 points. If I go to micros, I usually, because I need to make more money for the commission, need to get a few more points out of it because it's just not adding up as fast. So then I usually start with 3 points minimum. But if you were to use that 3, 5, 8, 10, and 12, that'd be 1, 2, 3, 4, 5. Let's say you add a 6th one. So now you go 6 micros and you put the last one at maybe at like 25 or 30. So that if it does pop up when we're clipping at 18, 20, 25 points a minute, and it bounces up, you can make more profit, right? Because if it's pinging that fast, you're going to hit these. So this has to be a little bit taken into consideration with the size of your account, what your trailing stop limit intraday is, and how fast the market is moving. So you've got to be willing to adjust the ATM strategy to be compliant with how we're moving. So maybe you save a couple different options based on the speed of the market. A slow market, a medium or normal market, or a fast market. I actually have some of my strategies that say that. Slow, normal, fast. Okay, at the very end. So I can just see, oh yeah, that's that one. That's fast, that's slow. And I build the targets to comply with what's happening. If it's really fast, because of what we saw right here, I want to try to get a couple. I want 3 points, right? How much did that move? Let's just say you're able to get in there quick by, somewhere up here. Well, there's 4 points. So if you set, after you see that doji, if you set a target with at least 3 points, and then you put your stop at 5, right? You might have gotten the first 1 or 2 if you do 2 or 3 points, and then the rest get stopped out because you can't control as fast. Now, Matt made a comment about our conversation earlier today, is I want you guys not to be trading like robots. Just because you have a stop loss set at minus 12 or minus 5, does that mean you have to let price come down to minus 12? Either or, 5 or 12 on you? No. What can you guys do to create a tighter stop loss in effect? You have, at least on Sierra chart, a break-even button, or you have a flatten button, or you have a cancel all button. So you have 3 different options to stop yourself out of the trade. If you got into it and then it just started to reverse against you and the hairs on the back of your neck stand up and you're like, nah, I don't want that. Flatten, cancel all. All right. Understand on your particular charting software what the difference might be between flatten and cancel all. There may be some differences in how it's programmed. Okay. For a different discussion. But I will either see the bounce, and then after I see the bounce and I'm a little iffy, but I don't want to stop myself out, I go break even. And that takes the stop and it moves it to wherever I got in. But if it continued to bounce up, I'm not taking myself away from the 5, 8, or 10 points that it might continue to go. Whereas if you hit flatten or cancel all, you have now not only raised your stop but you've taken out of the trade completely. So if you were right, even though the hairs on the back of your neck were standing up, and it did continue to bounce for 10, 20 points, now you've lost the ability to have those profit targets get you anything. So my first reaction is, if I'm clipping fast, is I go to that automated trading strategy. Okay, I reduce my lots. I trade more extremes prices. I look for more confluence. And then I'm much more willing. I say this a lot in the room. Hand on the mouse. Hand on the mouse. Why do I say that? Because if you want to be an expert at sniping, then you need to not let the robots do it all for you. You need to be able to tell yourself, flatten all, flatten all, flatten all. Okay? Break even, break even, break even. What happens if it did this? I've talked about this before. It bounces up like you thought, came back down right here, had a fractal, and then it did this. Don't be afraid. And this is the whole reason why we say risk management. Preserve your bullets. We have 20 to 40 trades a day, so we don't let greed or fear impact our trading decisions. And we have risk management procedures based off of ATR and VIX that tell us how tight our stop should be or whether we're playing more extremes. So now I do come take this trade when it is clipping at 22 points a minute. It comes up, it comes back down. I stop myself out. I lose 1 or 2 points on a couple of them. And then it starts to bounce back up above my trade entry before. And I'm like, oh crap, they just did a fake me out. Okay, buy it again with a 5-point stop. Buy it again. Buy, break even, flatten, buy. Flatten again if it comes down again and fakes you out. You can get in and out of this trade 3 or 4 times in 40 seconds. There is nothing that sits there and tells you that you have to stay in a trade for a minute. So become a professional sniper when you need to. You still need to trust the system when we're in our normal trading range on an ATR or a VIX level. Okay, when we're adhering to our first touch rules in certain times of the day, right? No 4-6. Nobody trades in the first 30 minutes unless you're skilled and you've proven to yourself you can do it. Nobody's going to start trading a 10 until after 25 after. Why do you guys think I put that rule in there? No 10s until after 25. Because of everything I've already explained to you. It whips through the 10s even on normal days when you're sitting there at 16, 17 minutes sometimes in the first 50, 55 minutes. So what did I do? I created a set of rules that gave you a limitation of playing more extremes. I didn't allow you to take, not allow you, but I didn't recommend, right? No 4, 6s, or 10s in the first 50 minutes, just so it would protect you. All risk management. Do not be a robot. Yes, we have eye sniping rules as you are learning, if this, then that. But become a professional trader and be willing. In, out, or I'm not trading at all and I'm sitting on my hands, waiting for confluence. There will be times we don't want to trade. Now, one last point, then I'm going to open up some questions, and if people need to leave, they can leave. Let's just say Matt's done this, a couple other people have done this. Let's talk about DCAing versus adding to a winning position. Let me find a good example of this. Oh well, let's just pick our picture. That'll be quicker. Let's look at our slideshow. Okay, if I am doing price discovery, maybe I'm in a Wyckoff rectangle box, consolidation box where I'm looking for a Wyckoff spring. Maybe I'm hit my profit limit already and I've switched from trading minis to micros. Maybe I'm clipping at a faster ATM per minute than I'm normally comfortable with, but I do want to use a 5-point stop with 3 micros only. So I'm taking a very small trade with a very tight stop just in case I get this 68-point impulse move up. Because we know we like 15 and 20 lines with an eagle. Okay? We like those. Great trades. Price is coming all the way up here. And then we finally get our first pullback to the middle of the cloud. It's like hitting a Fibonacci level, right? We like the reaction off of those. But for whatever reason, like I said, I want to limit my risk here. I put a 5-point stop. I see the reversal. Now, let's assume we got in somewhere right at the top of this circle, and you start to see that impulse move. Add to your position on the winners. I'm not talking about dollar cost averaging. I'm talking about adding to a winner. If you have that smaller profit target range that I was talking about of having 3 points, 5 points, and then 8, 10, 12, and 25, all right, then I could add, even though I went up, now I'm 3 to 5 points away from the line, but I'm seeing an impulse move. I'm seeing volume come in. Maybe it was a liquidity zone and we're saying, hey, off a Bookmap, that was a market pulse VPI spike also. Maybe it's a Fibonacci plus an ace line, right? Look for those confluence points where we want to add to winners, because what we're going to do is we're going to make more money and have less risk by becoming better traders by not just trading the iSnipe lines. Because yes, we can trade iSnipe lines all the time on a standalone system with a 78% win rate. We've shown it day after day after day. But if you learn both systems, okay, and you look at the confluence from both sides, and you start adding to winners when you see those confluences on the bigger time frames, the 20, the 35 specifically I'm talking about, you can add to those winners and make a lot more money. So now I have 3 lots. I've just increased myself to 6. Maybe one of them got taken out at 3 points. So maybe I don't have 6, maybe I have 5 or 4. But now I can take a couple more, but I have 2 of them that were sitting up at 25. Now I'm clearly in profits. I take my 2 that are at the 12 or 25 if I'm fast enough, and I move them up higher. So I want you to have at least 1 at 25. If I legged into this twice with one of my last targets being 25, I'm taking profit as it goes up on those really closer ones, but I'm saving a couple of add-ons that were at the 25-point target, and it allows me to expand it out to let my winners run. So Bill, now I'm coming into the discussion of what you were asking about for the legging in, legging out. Leg into a trade and then leg in or add to a winner. As the winner continues to climb, you start legging out at certain spots. It either is going to happen automatically because you have smaller, closer targets of that 3 to 8 point range, or you're just using the opposite 4, opposite 6, opposite 10, leaving a runner. So when I look at this and I see this bounce, and now I see a 4 and a 6 develop on top of the 20 line, and I've talked about this before, 4s and 6s on this side, 4s and 6s on this side, forming a V-shaped recovery. When you see this pattern, this means you're adding. Maybe you don't add until you see that 4 and 6 line develop. Okay, add. Or you don't add down here, fine. You leg out, you let it pull back. I say this is a great place to take a 6. Maybe you leave 1 on. Let it pull back, add another 3. It starts spiking up again, add 3 more. Because this would be just like an initial entry. Now, you don't want to add up here at the 10 line. You don't want to add up here at the 15 line. Okay? You want to add after you see it starting to go up, taking one of your first targets, and is a strong impulse move. You see it bounce off the 4 and 6, and it starts another impulse move. You add again as it's climbing away, and then you start legging out again. And that's what I mean by legging in, legging out. Now, the other version could be dollar cost averaging, Bill. I expect over here 4, 6, 10. I don't know what it looks like to the left of the screen. I don't remember. Let's just assume, though, we thought this was the first touch of the 10. On a Apex type account, you could leg in one time here on this line. You can have one more leg in. So you better make sure that that only DCA, one time DCA they let you have, counts. So you either become the super sniper and you get out when it starts to blow below your line. Okay? Sorry. Starts to blow below your line. And then you get in again. So you either stop and then you re-enter on the next viable trade entry. Or if you feel very strongly that we're in an AM low turn to an AM high, or we're in a vertical DOS, or whatever the trade setup is that lends us to the strategy or the thought process that we're going to continue up on a take profit account, or a fast track account, you could actually leg in 3 micros here, 3 micros here, and now your dollar cost average is somewhere here. It bounces up for a winner. Now I see the volume come in. I'm bouncing off the 20 with the eagle like I thought. Now I add. Now I've brought my dollar cost averaging down again. And now I'm legging out as I continue to go up. So 2 different examples. One of adding to a winner at a couple different locations and legging out. One, either getting into an entry and stopping and legging in again on the next best entry, or a full up DCA one-time add from this spot to this spot to bring my average price down to here. Now it bounces up. Now I add again. Now I'm really in the green. All right, we have been talking for quite a while, hour and 43 minutes. That's probably good enough for tonight, but let's finish with any follow-up questions to anything we talked about. We will go down the row. Bill.
Well, the only question I have at the moment is that I don't have on my Discord, I don't have access to the Sierra Chart channel. On yours, I saw that there's like a major category called tools.
Yep.
And I don't have that, so maybe at some point you could.
Okay. Yep. That's not on you to do. That's for me and Eddie to do. Eddie and I will fix that for everybody.
Okay.
Eddie's our primary moderator and Discord guru, so he will make those changes to give everybody access to all the prop firms and all the tools.
All right, great. I appreciate it. No, other than that, it's been a real good lesson. Thank you.
Okay. Eddie, questions?
No, one sec. I was giving the access, but everyone should have that. It's a public channel. No, I think I'm gonna try the market's been a little faster, so I gotta adjust my ATMs. Because when it's not that fast, I'm okay with it. But when it gets a little faster, that's when I get a little bit in trouble.
Yep. When it's faster is when we get in trouble. So that's why we go from minis to micros. We cut our size in half. We play the extremes. We trade instruments. We can always go to the ES. Maybe we go to the YM. The YM can move pretty fast too, though. We can go to a different thing. Or what can we do? We can sit on our hands and wait for it to slow down. If we miss, if we only get to trade for 1 hour a day, let's say it's clipping. Okay, it's clipping at 33 points a minute in the first hour. We know it's not going to go 33 all day long through the slog. It doesn't do that. We have periods of time where it slows down. You will have periods of time where we will end up being below 20 points a minute, where you can trade for at least an hour or so during the day. So if that means sit on your hands until that time frame comes, then do that. Okay, McGuire, are you still on or able to ask any questions?
Yeah, I was able to go back and forth. Sorry if I missed it if you called me, but no, I heard most of it. Definitely, there's some new things I have to get into again. couple of changes from when I started with you, but no, I mean everything seems to be good. I love the chat today, so.
Okay, sounds good. Monkey.
No, I don't have anything. I don't think. Check if you want to, Kelly. Check a DM for me.
Yeah, I got it. We'll cover that another time, though. Just we're running out of time today.
Good enough. That's it.
Okay, Matt?
None for me. Thank you for your time. Really appreciate it.
Stefan?
No, I mean, here's my issue is actually sitting here all day this night. If I have a full-time job I have to go to, so I have a tendency to rush it in the morning. If my first trade is a loser, what's your natural mindset? Oh crap, I need to get that money back, and then it's usually downhill from there. That's really what I need to work on.
Yeah, so for you, Stefan, one of the risk management things we need to do for you, and I know I've said this a couple times, I have not been trading pre-market as much as I normally have just because everything that's going on with my house and my life right now. So I haven't had as much time to trade pre-market. But one of the risk management things that we can do for you, where you have to work much earlier in the day than some of us, is we trade pre-RTH, the first hour and a half, maybe sometimes 2 hours. And I know the majority of the time frame, you're the first one in the room. So I know that you're available to do that. And I will try to get in to trade with you more in the early morning hours because the ATR rate is not as high pre-RTH. And the market tends to move, a decent distance in that pre-market hours. So for you, we need to try to trade a little bit more pre-RTH since, you start running out of time after the first hour and a half. But aside from that, make sure that for you maintain the discipline, that you don't let the fear of missing out because you got to go to work force you into taking bad trades when you should either be reducing your risk or sitting on your hands, right? And I know you know what I'm talking about.
If I took a bad trade, then I missed the good ones because I'm like, oh, maybe that's not the right setup. I'm missing something.
That's right. Well, you're in a tougher situation.
Like, oh, did you catch that?
Yeah, you're in a tougher situation because you have to go to work earlier, so you don't get the catch-up time later in the day that some of us do. So honestly, trading is harder for you because you have to be much more disciplined on your risk management because of that factor. But you and I, let's table that for now. You and I will have a little more one-on-one this weekend, and we'll talk a little bit more stuff. All right, last person is Tony. Anything else from you?
No, just a couple things for Bill at the top of the channel list. If you click on Browse Panels, you can select Sierra Chart, and it will then give you access to see that. My kids start school next Thursday, and so Stefan, I can get back on early because I see when people get on, but because my kids are still asleep or I got to run them to practice, I'm not on. But come after August the 1st, I'll be back on like at 7:30 like I used to be. And then Kelly, when we were on the 20 Eagle slide, I believe I heard you say when you were talking about adding to winners, when you see the 4 and 6, you add in again. And then when it pulls back to the 4 and 6, you add. So I've been adding to winners when it's been pulling back on the 4 and 6, and that's been working. But when I start to see that impulse moving at 4 and 6 develop, I'm going to try and get in again right there to add to my winner and see how that works. Because that would definitely pad it up for me.
Awesome. Okay, good.
Hey guys, I just clicked up on, I just went up on the upper left part of the screen.
Hey Bill, I'm going to finish this. Just table that for a second. Let's finish this video. All right, guys, we've been going for an hour and 38 minutes. We're going to let everybody that wants to get off, get off. If you have any questions, please DM me. We're going to come to a close. So thank you, everybody, for participating for an hour and 40 minutes.
Thank you, sir. Thanks, guys.
Hope it was good. Crash out. End of recording. Bye.
Later.